Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. Welcome to another one of these quick market updates. And with all the news coming out of that insider trading scandal in Washington, I wanted to use this video to really blow the lid on how the market is rigged against regular investors. Now, this isn't a conspiracy theory, and this isn't paranoia. I worked for more than a decade as a venture capital analyst and as an equity market analyst for private wealth management. I've seen how the market is rigged against those mainstream investors. Insider trading is everywhere, and I'm going to show you 3 real-life examples of how the market is rigged. But I don't want you to think that you still can't make money, so I'm going to reveal 3 ways to invest that even though the deck is stacked against you, you can still make those high returns. Now understand, when I say the market is rigged, it's not exactly like Scorsese's Wolf of Wall Street, but there are definitely ways that insiders and money managers cheat mainstream investors to get rich. Our first example here is insider trading, and this is when someone with non-public information about a company uses that to their advantage. There's 2 ways really that insiders make money on this information. First, they either buy or sell the shares themselves. So if the CEO knows the company is going to announce a buyout offer or some other great stock market news, they pick up a bunch of shares for themselves before that pop in the stock price. Now, more frequently, of course, is that the insider is going to give that information to someone else. That person buys the shares, and then they kick back some of the profits to the source. Now, insider trading has been illegal since the Securities Exchange Act of 1933, and the law says that it's not fair that these company insiders or their friends should be able to have that unfair advantage. But some people are always going to find ways around that. One of the most famous cases here involved Phil Mickelson. That Phil Mickelson, 3-time Golf Masters winner Phil. Now, Mickelson was never a big stock market investor. Despite earning upwards of $90 million playing golf, up until 2012, he had only invested about $250,000 of that in the stock market. Then, all of a sudden, out of nowhere, old Phil becomes a stock-picking genius, buying up shares of Dean Foods over a couple of months and making over $931,000 in profit. Yeah, something was up. Turns out, Phil owed some pretty big gambling debts to a Las Vegas businessman named Billy Walters. Now, Billy had been indicted numerous times by the FBI and local police in other crimes, but they could never get it to stick. But back to our story and how Billy helped old Phil get a little bit richer. It turns out Billy also knew the chairman of Dean Foods, Thomas Davis. And when I say they knew each other, I mean Davis was another degenerate gambler that owed Billy a lot of money. Well, you don't have to watch too many Scorsese movies to know you don't owe a Las Vegas businessman money for too long. As chairman, Davis knew that Dean Foods was going to announce its spin-off of WhiteWave, an organic food subsidiary, pretty soon, and the shares would just rocket when that information became public. Now, so Davis tells Billy Walters the scoop to cover his $2 million in gambling debts that he had racked up. Walters, eager to collect on money that Mickelson owed him as well, shoots a text message to his old buddy Phil. When that spinoff was announced, shares of Dean Foods surged 40%. Walters makes over $40 million just on this one bet, and Mickelson comes away with a cool $1 million. Now, the case against Davis and Walters is pretty classic insider trading. As an insider, Davis knew that information would mean to the stock price. Walters knew that Davis had the goods and could use it to make millions. And this thing played out in the courts for a long time. Davis ended up turning on Walters and testifying against him to get a deal. The former chairman ended up getting just 2 years in prison. Walters wasn't so lucky. He was convicted in 2017 on securities fraud, conspiracy, and wire fraud, pretty much the holy trinity in these insider trading cases. Here's where the rules of insider trading get a little shady, though, and how it goes so often. Now, Mickelson's trading was used as evidence against Walters, but he never testified. Phil's lawyers threatened both sides that if he was called as a witness, he'd take the fifth to avoid getting himself in trouble, and they couldn't use any of the information in the case. So the government could never prove that Mickelson actually knew the original source of that information. Now, it's possible that Walters never told him who that insider source was at Dean's Foods, and I don't know about Phil, but I'm not betting $2.4 million in a stock of a company without a pretty good idea that my investment is a sure thing. Mickelson did later cut a deal to return the profits and the interest to avoid being named as a relief defendant in the civil case, but pretty much got off scot-free. And the moral of the story here, though, is just that ignorance is bliss when it comes to a rigged stock market. Insider trading laws were changed in 2014 that to be convicted of the crime, you had to know, 1, the original source of the information, and that they were benefiting from that sharing that information. So a lot of those lovable folks living there in the 1% lane are getting rich from information passed down through their groups of friends. As long as they can deny knowing who the original source is, they just keep on making that money. A more recent example of how the market is rigged against us, another insider trading case hitting the news right now. Nation, on January 24th of this year, a group of senators are called for a secret meeting with the Senate Health Committee and members of the Centers for Disease Control, the CDC. Now, the subject, how a new virus out of China was going to destroy the U.S. economy over the next several months. At that meeting were Senators Richard Burr of North Carolina and Georgia Senator Kelly Loeffler. Now, this was all about a month before the coronavirus just slammed the stock market, around February 20th, catching investors totally off guard. Not all investors, though, it seems. Senator Burr sold 33 stocks on February 13th, worth up to $2.3 million, including shares of a hotel company that would just get obliterated in March. Senator Loeffler didn't make out too badly either. She ended up selling stocks worth up to $3.1 million, as well as buying stock in two companies that would actually benefit from the pandemic. Now, both are trying to say that their inside information had nothing to do with it. Loeffler is actually a former executive at the Intercontinental Exchange. That's the owner of 12 stock market exchanges, including the New York Stock Exchange, and married to Jeffrey Sprecher, a current chairman at the NYSE. So you can't tell me they didn't know what they were doing. And if all that weren't bad enough, in a bizarre twist, prior to 2012, members of Congress weren't prohibited from trading on this kind of insider information. They could get in these secret meetings, go out and trade, make money off of this before anyone else, and there was nothing illegal about it. In fact, Senator Burr was one of the key opponents, one of the only 3 senators to vote against this Stop Trading on Congressional Knowledge Act in 2012, calling it ridiculous, calling it insane. So it kind of makes you wonder how many other times that this guy was using this inside information as a senator to make a killing in the market. Now, just one more example here before we get to how to invest to beat this rigged market. And I'll make this one quick because after those first two, I can imagine you're already as pissed off as I am. This one comes from the fact that there are actually 2 different types of financial advisors. You see, one type, the registered investment advisors, they're regulated by the Financial Industry Regulatory Authority, or FINRA. These advisors, by law, have to keep their clients' best interest in mind when they're recommending investments. The other type of advisor, a registered broker, doesn't have that same requirement. They have a much weaker rule that just says that they have to make sure the investment is suitable for their client. But that means they can suggest all kinds of investing products, including ones that come with high fees and kickbacks to that advisor. It's a system that's made these brokers rich in fees. It's led to an explosion in shady investment funds and widespread misconduct. In fact, a survey by the University of Chicago found that as much as 20%, that's 1 in 5 advisors at one brokerage firm, had been disciplined for misconduct. Now, this is an older study released in 2016, so I'm not saying that these brokerages are shady, but these numbers are just plain scary. At UBS, number 4 on the list here, 15% of their 12,000 advisors have been disciplined for misconduct. That's over 1,800 advisors caught doing something they shouldn't be doing with their clients' money. Now, this was all supposed to change with that new fiduciary rule. That law was supposed to go into effect April 1st of 2017 and said that all advisors had to hold their clients' best interest in mind, that they couldn't recommend some of these high-fee investment products. Well, in the ultimate April Fool's Day joke, the courts struck down this law and the government didn't fight for it, and we're right back to where we started, with a rigged market. Now, folks, the tragic fact is that there isn't much you can do about this as a regular investor. The market is rigged, insider trading is rampant, and that's just how it is, unless you can get Congress to do anything about it. And we've already seen that they're just as much part of the problem, so there's nothing going to change here. There are 3 rules, though, 3 ways you can invest, though, to still make money. 3 strategies that you can use to get those returns and actually beat the market. First here is simply investing for the long run. So if you know that the insiders are manipulating the short game in stocks, making money on and trading on that news, then you need to play the long game. The stock market has produced a 9% annual return over decades, and that's actually pretty darn good. So just put together a portfolio of stocks, bonds, and real estate that are going to get you that high return while protecting you from the big sell-offs like the one we just went through. Own funds that cover broad themes and a few individual stocks that you really like. Next here is to invest before the stock market cheats have their way with the market. Since the Jobs Act passed in 2012, even Main Street investors can get in on these pre-IPO companies through equity crowdfunding. Now, this is a high-risk investment, folks, and investing in these startup companies, so you need to do your research on every single deal here. But getting in on these before they're available in the stock market, in that open market in an IPO, I worked as an analyst for this kind of market, as a venture capital analyst, and there is no better return. The third strategy here is to take advantage of every legal loophole you can. There are tax breaks you can get from investing in retirement accounts, 529 plans, even health savings accounts. These are all going to give you that special loophole to save money on taxes and your investments. This is the best way to get that little extra out of the market, and too many investors just don't take advantage of it. Click on the video to the right to avoid that value investing trap. 3 true value stocks in the market and the stocks you need to avoid. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.